Picture this, you're in a trade and it's heading your way. How much should you be aiming to profit? $100, $200, or maybe $300? Well, the answer lies in understanding the risk-reward ratio, one of the most potent tools in trading. Whether you're delving into stocks, forex, crypto, or any other market, mastering risk-reward ratios can significantly boost your profitability. In today's video, we'll dissect the 1-to-1, 1-to-2, and 1-to-3 risk-reward ratios. You'll learn about their unique traits, advantages, and disadvantages. By the end of this video, you'll have a clear roadmap to navigate these ratios effectively, enhancing your trading strategy and potentially boosting your profits. Let's dive in. A risk-reward ratio is a simple yet powerful concept that helps traders strike a balance between their potential losses and gains in the market. It is essentially the amount you're willing to risk losing on a trade divided by the potential profit you could make from that same trade. Let's break this down with an example. Say you buy a stock at $100 per share and you think it'll go up. To protect yourself against losses, you set a stop-loss order at $95, which means if the stock price drops to $95, you'll automatically sell the stock, limiting your loss to $5 per share. On the flip side, you set a take-profit order at $105. This means once the stock hits $105, you'll sell and book a profit of $5 per share. Here's where the risk-reward ratio comes into play. In this scenario, you've set a risk-reward ratio of 1-to-1. You're risking a $5 loss for a potential $5 gain. If the stock price goes above $105, increasing your take-profit level and keeping your stop-loss at $95, you can increase your risk-reward ratio. For instance, if you raise your take-profit to $110, you're now looking at a 1-to-2 risk-reward ratio, risking $5 to make $10, and if you take it further to $115, it becomes a 1-to-3 risk-reward ratio, risking $5 for a $15 profit. In essence, a risk-reward ratio helps you define the boundaries of your trade, deciding how much you're willing to lose and how much you want to gain. It's a crucial aspect of trading that allows you to stay disciplined, manage your emotions, and make more informed decisions in the market. Now that we know what a risk-reward ratio is, let's discuss why it is such a vital tool for traders. A risk-reward ratio is not just a random figure. It's a carefully considered tool that plays a pivotal role in every trader's arsenal. One of its primary uses is in managing your losses. In the unpredictable world of trading, losses are inevitable. However, by setting appropriate risk-reward ratios, you can limit the impact of those losses. Let us say you have $1,000 in your trading account and you decide to invest $100 in a single trade with a risk-reward ratio of 105. If the trade goes against you and you end up losing, your loss would only be $20, which is 2% of your total account balance. By keeping losses small, you can ensure that a single losing trade won't wipe out your entire account. Secondly, a risk-reward ratio promotes consistency in your trading. It encourages you to take only those trades that meet your predefined risk parameters. By doing so, you train yourself to avoid impulsive decisions driven by greed or fear, leading to a more disciplined and consistent trading approach. Finally, a risk-reward ratio aligns with various trading strategies. Whether you're a day trader looking for quick profits or a long-term investor focused on growth, different strategies call for different risk appetites. A risk-reward ratio allows you to tailor your risk exposure based on your chosen strategy, ensuring that your approach remains sustainable and profitable in the long run. That said, a risk-reward ratio alone doesn't guarantee success in trading. While it's a powerful tool, it should be used in conjunction with other trading principles like technical analysis, market research, and money management. Now that we understand the importance of a risk-reward ratio, let's delve into the specifics of 3 common ratios: 1-to-1, 1-to-2, and 1-to-3. Each of these ratios has its own characteristics and implications for your trading strategy. Let's start with the 1-to-1 risk-reward ratio. In a 1-to-1 ratio, you risk the same amount as the potential profit. For instance, if you risk $10, you can expect a $10 profit if the trade goes in your favor. This ratio is often seen as the most balanced approach as it directly links your risk and reward. However, it is essential to recognize that a 1-to-1 ratio means you're not making any additional profit beyond your initial investment. Next, we have the 1-to-2 risk-reward ratio. This ratio, as the name suggests, involves risking $10 to make $20. This means your potential profit is double the amount you re-risking. A 1-to-2 ratio is generally considered to be more favorable for traders since it offers the potential for greater gains while still maintaining a manageable risk level. It is important to note that achieving a 1-to-2 ratio can sometimes be challenging and may require patience to find the right trading opportunities. Finally, let's discuss the 1-to-3 risk-reward ratio. This ratio is the most rewarding of the three, offering a potential profit that's 3 times the amount you risk. So if you risk $10, you can expect a profit of $30. However, it's also the most difficult to achieve. Finding trading opportunities that meet a 1-to-3 ratio can be tricky and often requires experience and expertise. Additionally, there's a higher chance that the trade may not go in your favor, resulting in a larger loss than in the previous ratios. While these ratios provide a framework, remember that each trade is unique. The actual amount you risk will depend on factors like your overall portfolio, the specific trade, and your risk tolerance. In this part of the video, we'll explore the advantages and disadvantages of each risk-reward ratio, helping you understand their strengths and weaknesses. Starting with the 1-to-1 ratio, the main advantage is its simplicity. It provides a clear and direct relationship between your risk and reward, making it easy to calculate potential profits and losses. Additionally, the 1-to-1 ratio is suitable for traders who prefer a more conservative approach, allowing them to manage their risk effectively without taking on too much exposure. However, the disadvantage of a 1-to-1 ratio is that it doesn't offer any room for substantial profit. You're essentially breaking even, and the potential for growth is limited. Moving on to the 1-to-2 ratio, the primary advantage here is the potential for higher gains. With a 1-to-2 ratio, you can double your investment if the trade goes in your favor. This makes it an attractive option for traders looking to maximize their returns. Moreover, a 1-to-2 ratio allows for more flexibility in your trading. You can adjust your stop loss and take profit levels to fit the specific characteristics of the market and the trade you are pursuing. However, the challenge with a 1-to-2 ratio is that it can be more difficult to execute successfully. You need to have a good understanding of the market and a well-defined trading strategy to increase your chances of profitability. Finally, let's discuss the 1-to-3 ratio. The main advantage of this ratio is the potential for substantial profits. With a 1-to-3 ratio, you can triple your investment if the trade goes in your favor, offering a high return on your initial risk. This makes it appealing for traders seeking significant growth and high profitability. However, the significant disadvantage of a 1-to-3 ratio is the increased risk involved. If the trade goes against you, you'll also lose more money than with the other ratios. It requires patience, expertise, and a deep understanding of the market to execute this ratio successfully. Remember that the best risk-reward ratio for you will depend on your individual trading style, risk tolerance, and financial goals. It's essential to test and refine your approach to find what works best for you. In the final part of our discussion, we'll analyze the profitability of each risk-reward ratio using real-world examples and data. This will give you a clearer understanding of how these ratios impact your bottom line and help you make informed decisions when trading. Let's start with the 1-to-1 ratio. With a 1-to-1 ratio, your profit is directly tied to your risk. If you risk $10, you can expect a profit of $10 if the trade goes in your favor. While this provides a sense of balance, it also means that you're not making any additional profit beyond your initial investment. Over time, this can limit your overall profitability and make it challenging to grow your trading account. Next, consider the 1-to-2 ratio. With this ratio, your potential profit is double the amount you risk. If you risk $10, you can expect a profit of $20 if the trade goes in your favor. This offers more potential for growth and profitability. Assuming you have a 50% win rate, you're risking $10 to make $20, which gives you a profit factor of 2. Multiplying your profit by your win rate, you'll see a net profit of $10. Over a significant number of trades, this can lead to substantial gains in your trading account. Finally, let's examine the 1-to-3 ratio. With this ratio, your potential profit is 3 times the amount you risk. If you risk $10, you can expect a profit of $30 if the trade goes in your favor. This offers the highest potential for profitability. With a 50% win rate, you're risking $10 to make $30, giving you a profit factor of 3. Multiplying your profit by your win rate, you'll see a net profit of $15. Over many trades, this can result in substantial growth in your trading account. It's important to note that profitability also depends on factors like your trading strategy, execution, and the efficiency of your risk management. The optimal risk-reward ratio for you will depend on your unique trading style, risk tolerance, and financial goals. Whether you opt for a conservative 1-to-1 ratio, the balanced 1-to-2 ratio, or the aggressive 1-to-3 ratio, it's crucial to understand the implications for your profitability. Analyze your trading data, consider your risk appetite, and continually refine your strategy to find the right fit for you. For each ratio, we will go over two things. So the advantages and disadvantages of using that ratio. That way you can see which one is best suited for you and your trading style. If you're new here, welcome to the channel where we discuss everything day trading to keep you profitable. If you want to learn more about ratios and how to use them, make sure to watch my last video called "What is the best risk-reward ratio?" You can find it somewhere over there. But without any further ado, let's get straight into the video. Alright, so starting with the 1-to-1 ratio. The first advantage to this ratio is it has the highest win rate potential. As you can see right here, the 1-to-1 ratio only needs to travel up 100 pips to hit our take profit. This makes it easier to hit our take profit because the target is much smaller compared to the other ratios. A lot of people like this ratio because it's perfect for scalping or day trading. So if you are a scalper or day trader, this ratio might be the one that works best for you. That's because the 1-to-1 ratio gives you a great reward to risk ratio while also keeping you out of the markets quickly. Also, you're less exposed to the market's volatility when using the 1-to-1 ratio. This means you can scalp quickly and still make money. So as you can see, the 1-to-1 ratio is really good for scalping. It allows you to make a lot of trades, and remember, you don't need to take a ton of trades to make money. Just make sure you're profitable on each trade. Take a look at this example. We have a scalper making 5 trades in an uptrend. Each trade is risking 10 pips and targeting 10 pips. The scalper is making use of the 1-to-1 ratio, and by doing so, he is able to walk away with 40 pips of profit. Since he had a 60% win rate, this was a very good day of trading. And what would his results be if he was using a different ratio? Let's find out. So now let's talk about the disadvantages of the 1-to-1 ratio. So the first disadvantage to the 1-to-1 ratio is it's not very profitable. As you can see right here, the 1-to-1 ratio doesn't make a lot of profit. This is because the 1-to-1 ratio needs to hit its take profit 100% of the time. To be profitable, this isn't always easy to do since you're essentially saying, if I enter this trade, I need to be 100% sure I'm gonna make money on this trade. Another disadvantage to the 1-to-1 ratio is the fact that it doesn't have any upside in a strong trend. Take a look at this example. We have a day trader making trades during a strong uptrend. Each trade is risking 10 pips and targeting 10 pips. The day trader is making use of the 1-to-1 ratio. By doing so, he's only profiting 10 pips per winning trade. Even though the market goes up to 100 pips, he's still only profiting 10 pips. He could have made much more money if he was using a different ratio. Let's find out. Next up, we have the 1-to-2 ratio, so starting with the advantages. The 1-to-2 ratio is a balanced ratio. In my opinion, it's a good ratio for swing trading or trading moderate volatility. The reason why it is a good ratio for swing trading is because the take-profit distance is not too far, but it's also not too close. This makes it very manageable for long-term trades. Now, unlike the 1-to-1 ratio, the 1-to-2 ratio doesn't require a 100% win rate to be profitable. The 1-to-2 ratio only needs a 50% win rate to be profitable. So if you think about it, you're getting double the chances of being profitable versus the 1-to-1 ratio. This makes the 1-to-2 ratio very appealing to many traders because it is more forgiving than the 1-to-1 ratio. Let's take a look at this example. We have a forex swing trader making trades during an uptrend. Each trade is risking 20 pips and targeting 40 pips. The forex trader is making use of the 1-to-2 ratio. By doing so, he's able to profit 20 pips on every winning trade. Even though the market goes up 100 pips, he's still able to profit 20 pips. Now let's talk about the disadvantages of the 1-to-2 ratio. The first disadvantage is it's harder to hit your take profit in a choppy market. As you can see right here, the 1-to-2 ratio needs to travel up 100 pips to hit our take profit. This makes it harder to hit our take profit because the target is much bigger compared to the 1-to-1 ratio. The second disadvantage to the 1-to-2 ratio is that it's harder to be profitable. This is because the 1-to-2 ratio needs to hit its take profit 50% of the time to be profitable. This isn't always easy to do because sometimes it's hard to find good trades. Let's take a look at this example. We have a forex swing trader making trades during a sideways market. Each trade is risking 20 pips and targeting 40 pips. The forex trader is making use of the 1-to-2 ratio. By doing so, he is only able to make 40 pips of profit, even though he had a 60% win rate. Next up, we have the 1-to-3 ratio, so starting with the advantages. The 1-to-3 ratio is the most profitable ratio. As you can see right here, the 1-to-3 ratio makes a lot of profit. This is because the 1-to-3 ratio needs to hit its take profit 33% of the time to be profitable. That means you have 3 times the chances of being profitable versus the 1-to-1 ratio. Another advantage to the 1-to-3 ratio is the fact that it's very rewarding for disciplined traders. The 1-to-3 ratio is not very common and a lot of people won't use it. So if you are disciplined enough to use the 1-to-3 ratio, you'll be rewarded heavily. Let's take a look at this example. We have a position trader making trades in crypto. Each trade is risking 50 pips and targeting 150 pips. The position trader is making use of the 1-to-3 ratio. By doing so, he's able to profit 100 pips on every winning trade. Even though the market only goes up to 100 pips, he's still able to profit 100 pips. Now let's talk about the disadvantages of the 1-to-3 ratio. The first disadvantage to the 1-to-3 ratio is it's not very common. So not every market will have a 1-to-3 risk to reward ratio. This means you might have trouble finding trades. The second disadvantage is the fact that the 1-to-3 ratio needs a distant take profit level. This means that it's not the best ratio for momentum trades. Let's take a look at this example. We have a position trader making trades in crypto. Each trade is risking 50 pips and targeting 150 pips. The position trader is making use of the 1-to-3 ratio. By doing so, he stopped out on every trade, even though the market goes up to 100 pips. Remember, there is no best ratio. It all depends on your trading style and the market conditions. Let's go ahead and get started. So what we're gonna do now is actually put this into a live chart. So in this case it's 1-to-2. Then you now ask yourself the question, are you a beginner trader? If yes, then you should use the 1-to-1 ratio. However, if you not a beginner trader, which in this example we not because we targeting a 1-to-2 ratio, because that's what the chart is telling us to do, then we move on to the next question. The next question is, do you scalp or do you have high probability setups? So if you do, then go for the 1-to-1. However, if you do and you either a swing trader or the market conditions are mixed like this is the case for this example, then you're going to go for the 1-to-2 ratio. Let's move on to the last scenario. The last question is, are you an experienced trader and do you follow trends or do you trade high volatile markets? If yes, then you can use the 1-to-3 ratio. However, if no, then you should use the 1-to-2 ratio. So since we are trend followers, we're gonna be using the 1-to-3 ratio. So to summarize, the 1-to-1 is best used for beginners, scalpers, or high probability setups. The 1-to-2 is best used for swing traders or mixed market conditions, and the 1-to-3 is best for experienced traders who follow trends or trade high volatile markets. However, keep in mind that profitability also depends on your win rate. For example, if you have a 50% win rate, trading with the 1-to-1 ratio will actually be more profitable than trading with the 1-to-3 ratio. Also, if your strategy doesn't work well in trending markets, then you shouldn't be using the 1-to-3 ratio even if you're an experienced trader. Okay, so now that we understand which ratio to use, there are a few things that you want to avoid when it comes to trading with ratios. First off, you never want to move your stop loss simply so that you can achieve a certain ratio. So in this example, let's say we want to achieve a 1-to-3 ratio. So we're going to have to move our stop loss further back right here. Never do that. That's absolutely wrong. Your stop loss should always be determined by the current market conditions and structure, not based on the ratio that you want. The second thing you don't want to do is ignore the volatility of the market. For example, in this scenario, we have the 1-to-2 ratio, but notice how much volatility there is in the market. So if you place this trade, you could have a large drawdown. So sometimes it's better to take the 1-to-1 instead. Always consider the context of the market. The third mistake that you do and want to do is overtrade in order to chase a higher ratio. For example, you might be thinking that the 1-to-1 ratio isn't good enough for you. So then you wait, and then finally you get your 1-to-3 ratio, and then you place the trade, and then it turns out that this trade goes against you, and you end up losing it. So that's something that you definitely don't want to do. You never want to sacrifice your capital just to try to get a higher ratio. Okay, so now let's go over a few final tips before we wrap this video up. Tip No. 1. Before you start trading with ratios, make sure to backtest your strategy on a demo account so you can figure out which ratio works best for your strategy. Tip No. 2. Combine the ratios with proper position sizing and risk management. So for example, you might want to risk only 1-to-2% of your total capital per trade. This is a very important concept when it comes to trading. Make sure to check out our video on risk management if you haven't already. Okay, so now let's recap everything that we've learned in this video. So the 1-to-1 offers high win rates but lower profits. It's best used for beginners. The 1-to-2 balances risk and reward, and it's great for versatility. The 1-to-3 maximizes profits, but it requires a lot of patience and discipline. And lastly, profitability also depends on your win rate, your strategy, and the market conditions. With that said, it's time to take action. Test these ratios in a demo account and see what works for you. Share your results in the comments and let us know which ratio you prefer. Thank you guys so much for watching this deep dive into risk-reward ratios. We hope you enjoyed it, and we hope you learned something new. If you did, please make sure to leave a like on this video and subscribe to the channel so you can receive notifications when we post new videos. And with that said, thanks again for watching, and we'll see you in the next one.